Hi everyone, Neža here, and welcome to Stock Break, where I give an in-depth analysis on public companies in under 5 minutes, breaking down their fundamentals and potential valuation. Let's dive in. Hey everyone, today we will talk about Disney, so don't forget to like and share the episode if you found it interesting. But before we start, I would just like to remind you that this presentation is for educational purposes only and it should not be taken as investment advice or recommendation to buy or sell any financial instruments. Disney has been a leader in entertainment industry for almost a century now. They are most known for their iconic characters, movies and theme parks. Over the years, the company has grown into a global powerhouse that is also owning ESPN, Hulu, and Disney+. Besides that, they also have their own cruise line that is serving million passengers every year. Despite many strengths, the company faced quite a few challenges in the past few years. The first one was rise of streaming businesses. This one majorly impacted their traditional sources of revenue like cable TV. Then there was pandemic, which had a major impact on their movies and theme park side of the business. This quarter, Disney managed to bring some of its magic back and investors took a notice. The stock jumped 12% after earnings release and it is up about 30% year to date. For the fiscal fourth quarter, Disney reported revenue increase of 6% to $22.6 billion, but even more exciting than that was their profitability. If we take a look at their diluted earnings per share, they increased by 79% compared to the previous year, and both of those numbers exceeded market expectations. Cost-cutting efforts are clearly paying off because operating profits and streaming business numbers are coming in double of what analysts were expecting. Even looking ahead, Disney is expecting brighter days ahead. For fiscal 2025, they are expecting high single-digit earnings per share growth and also dividend growth. Looking further in 2026 and 2027, they are expecting even double-digit earnings per share growth. For analyzing Disney, we're gonna take a look at few metrics that are important to look at when analyzing such a diverse business. First, we're gonna look at all of their business segments. Disney business is in short split into 3 segments, and that is entertainment, experiences, and sports. The biggest part of their business is entertainment, which makes up about 45% of their all operating revenue. This includes streaming services like Hulu and Disney+, which made a significant turnaround in the past year. In the last quarter, they reported a profit of around $250 million, which is a significant turnaround from last year when they reported $420 million in loss. The second part is experiences, which include their iconic theme parks and cruise lines. This makes up about 36% of their all operating revenue. Domestic parks here are thriving with strong guest spending, even though international parks are still lagging behind a bit with some challenges they're facing. Looking ahead, they are planning some new cruise ships and even park expansions, which are expected to fuel future growth. The last but not least is their sports segment, which makes up 18% of their operating revenue. ESPN is a major player here, and Disney is even planning to launch streaming app in the next year. Streaming apps and live sports are a major hit right now, and this could significantly boost their sports segment. Now we're gonna take a look at their debt ratio and its impact on their business. Debt to equity ratio simply tells us how much the company is relying on borrowed money compared to their equity when financing their operations. It's important for us because it shows us what is financial stability of the company. For Disney, debt to equity ratio is currently standing at 0.48, which is a manageable number for a company of this scale. However, if we take a look back, we can see some increases in the past. Those were related to some acquisitions. For example, they acquired Fox company and they needed extra funds to fund their expansion. And we can also see increase here during pandemic when they needed extra money to fund their operations. Now we're going to take a look at their profitability metrics. Here we have gross margin and operating margin on the same graph, and this metric shows us a clear picture of Disney's efficiency and ability to generate returns. Disney gross margin is currently standing at about 35%, while their operating margin is standing at about 13% at the moment. This shows us that the company is maintaining a solid efficiency, particularly in high margin areas like parks and licensing. They are even expecting their streaming business to scale up and parks to recover, which could boost their margins even higher. And this is supporting their guidance of high single-digit earnings per share growth in fiscal 2025 and double-digit growth in the following years. Now that we looked at some of the crucial metrics, we can continue with valuation. From my point of view, the company is currently at turning point. We could see from recent results that the company is finally showing much needed signs of potential turnaround. For example, we saw that streaming business is finally profitable, which is a clear sign that this strategy is working. Besides that, parks and experiences still remain a reliable cash generator, providing a consistent support. Also, if we take a look at company's forward PE ratio, which is currently standing at about 21, this number is lower than SB500's forward PE ratio, which is about 25, and Netflix forward PE ratio, which is standing at about 40. So number 21 really seems Disney like a reasonable value at the moment. On the other hand, the shares are still down 40% from their all-time high from 2021, which makes investors wonder if Disney can fully capitalize on its potential. There are definitely still some hurdles they need to overcome. For example, traditional TV business is continued to shrink as cable struggles to stay relevant, and streaming, while it is improving, it is facing tough competition from companies like Netflix and also from other platforms. Besides that, international parks are still lagging behind, and there is more potential in this area. Overall, I would say that Guru Focus sums up valuation pretty well. It is stating that the company is currently fairly valued, which means that it is not a bargain, but it could be a solid choice for some long-term investors who believe in companies' turnaround. From my point of view, I would say the Disney story is one of rebuilding. They have to manage risks and rewards at the same time while working on recapturing former glory. That's it about this magical company. Share in the comments how do you feel about Disney and which company would you like to see next time. Don't forget to like and share if you found this episode interesting, and see you next time.